no small matter what is happening in aluminum right now, and we have big developments over the weekend with Iran striking 2 aluminum smelters. Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, bringing you up to date. I mean, maybe you've already seen this. It was on front page of CNBC yesterday. Iran's attack on aluminum producers are sending, quote, shockwaves, end quote, through the metals markets. This is by Joseph Wilkins on Monday. So over the weekend, there were reports, I saw one from Al Jazeera, that there were strikes by Iran on aluminum smelters. Let's take a closer look here. Aluminum closed in on prices not seen since 2022, following Iranian attacks on 2 Middle Eastern producers over the weekend, heightening fears of a supply crisis for the industry. Don't forget, just last week, we read that article from the Financial Times where the word panic was used, and generally speaking, it's kind of one of those words that in journalism you don't use lightly. Of course, it was quoting someone, but nevertheless. So supply concerns persist. Let's continue. Futures prices on the London Metal Exchange initially jumped 5.5% on Monday to briefly touch $3,492 per ton, a price last seen in April 2022. Again, these moves are remarkably sanguine, is how I would characterize it. Only 5.5%. But I guess this is on already high numbers, as it is describing here. It pulled back slightly by Monday afternoon to land 3.5% higher at $3,381 per ton. Aluminum has risen around 10% since the conflict began on February 28th, though it fell briefly last week alongside most other assets amid fears of a global recession. I guess that is the only explanation. Again, a 10% move is significant, but when you consider that people are using the word panic in terms of supply, and automakers aren't sure where they're going to get their aluminum, and when you consider the ubiquity of aluminum, it seems like a pretty tame rise, doesn't it? Let's continue. Emirates Global Aluminum, EGA, and Aluminium Bahrain, or ALBA, 2 of the Gulf's largest producers, came under fire from Iranian drones and missiles on Saturday. EGA said in a statement that its Al Tawila smelter sustained, quote, significant damage in the strikes, injuring several people. Quote, the safety and security of our people is our top priority at all times, CEO Abdel Nasser bin Kalban said. Quote, we are deeply saddened and are assessing the damage to our facilities, end quote. Saturday's attacks only served to darken the outlook for commodity firms in the region, which have faced severe supply disruptions over the past month. Around 9% of global aluminum supply comes from the Gulf, and most firms there have been unable to export the metal beyond the region since Iran effectively closed the Strait of Hormuz. EGA's damaged smelter produced 1.6 million tons of cast metal in 2025, according to the statement. Now, it's an interesting question, because we were hearing reports, I believe it was ALBA, that was moving aluminum towards the Red Sea. I mean, it seems to me that it's easier to move something like aluminum than liquid natural gas, LNG. Whereas with metal, in theory, and I guess the question for me is can you put it on a train? I mean, they were sending it to the Red Sea, so they were moving it over land. Then we have an analyst, April K. Soriano, aluminum research analyst at S&P Global Energy, who told CNBC over email, quote, the attacks have sent shockwaves through the global aluminum market, raising the risk of a supply crisis that could reshape the industry. It harkens back to my discussion with Andy Holm last week on aluminum and the Strait of Hormuz, where he was saying you cannot overstate, was the word that he used, the impact of the aluminum market. It is everywhere. This isn't some specialty mineral, so to speak. She added that if the damage proves lasting, the market could move away from any temporary softness and begin to reflect expectations of tighter supply and higher prices. Joyce Lee, commodity strategist at Macquarie Group, told CNBC over email that their base case before the attacks that happened this weekend assumed a cut to the current running capacity of approximately 20%. Which amounts to roughly 800 to 900 kilotons of production loss in 2026. Lee said Macquarie saw this disruption as sufficient to push the global market into a full-year deficit, adding that they were closely monitoring the, quote, fluid situation for any changes. And scrolling down, we have a quote from Artem Volinets, CEO of miner ACG Metals, who told CNBC Europe, quote, "If the Chinese government decides that the prices are too high, they can restart a number of idle smelters in the country, and the world will be full of aluminum." However, in the following paragraph, S&P Global's Soriano, on the other hand, believes China's ability to ramp up supply is limited. Quote, "While there is some capacity to increase output, the global market remains exposed to further shocks, especially if the conflict spreads to other metal supply chains." Which brings up our featured guest, Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence. We continue on the Strait of Hormuz, of course, the topic at the center of the news narrative, and we are deeply involved here in the metals markets with sulfur, one of the many things that pass through the Strait of Hormuz that, generally speaking, people were not aware of. It is required for processing copper. And, according to Grant, anecdotally, there's maybe 3 to 4 weeks of supply in Congo. I mean, nobody knows for sure. These are anecdotes. But this sulfur issue may become actually quite a large issue should the situation persist. So we're watching that over there. And we also have other angles here. We have Reuters on March 30th yesterday as well. Iran blows hole in U.S. aluminum supply chain with smelter strikes. And this by Tom Daly and Pratima Desai. With attacks on the two biggest aluminum smelters in the Middle East over the weekend, Iran struck at major suppliers to the United States of a strategic metal the world's biggest economy does not produce nearly enough of domestically, analysts said. Before the weekend, disruption from the Iran war centered around the difficulty of shipping aluminum and raw materials through the Strait of Hormuz, which has been effectively closed by Tehran. But on Saturday, Emirates Global Aluminium said its roughly 1.5 million metric ton per year Al Tawila site in Abu Dhabi in the United Arab Emirates had sustained significant damage from Iranian attacks. Aluminium Bahrain said its 1.6 million ton per year plant was targeted on the same day. Neither company has since provided an update on operations, but the attacks have abruptly shifted concerns from temporary shipping snarls to a potentially more serious threat to production in the region. Quote, "That changes the nature of the risk," Paul Adkins, head of aluminum consultancy AZ Global, wrote on LinkedIn. London Metal Exchange aluminum prices reacted on Monday, leaping 6% to $3,492 a ton, close to a 4-year high. Quote, "In this sort of market, when you suddenly take out 3 million tons of capacity, it cannot be replaced," said Panmure Liberum analyst Tom Price. Scrolling down, the UAE and Bahrain, which through EGA and Alba make up more than 2/3 of the Gulf region's aluminum production, were the United States' second and fourth biggest suppliers, respectively. Iran said both EGA and Alba were linked to U.S. military industries, and the attacks followed Israeli strikes on 2 Iranian steel operations. Analysts, however, are skeptical. Quote, "There's no direct link to the U.S. military other than some of their metal might eventually go into military application through a long chain of changing hands and processing," said Wood Mackenzie's senior research manager Uday Patel. Price said he believed the U.S. military sources most of its aluminum from Canada. But while the U.S. military may not be directly impacted, that does not mean Iran's targeting of Gulf output and a potential deepening of the conflict are not inflicting damage on the U.S. and other major economies. Quote, "The stresses are already starting to show in terms of industrial activity and further hampering planning, which was already struggling on high levels of uncertainty," StoneX analyst Natalie Scott Gray wrote in a note. So the uncertainty continues. I mean, from a consumer perspective, there is almost cognitive dissonance, isn't there? Because we are reading these stories, you and me here at the Northern Miner podcast, as well as the general public seeing the stories on energy. Apparently there is, a rising gas price out there. I don't drive happily. I sold my car, 10 years ago. But nevertheless, you are hearing of rising gas prices. But overall, I go to the grocery store, you go online, you go shopping, you're not really seeing the impact yet. So there's almost a cognitive dissonance here between what we read and what is supposedly in the pipeline here, so to speak. So more, warnings here. Another story, this is Bloomberg. Iran's attack on Gulf aluminum plants threatens supply crisis. And this is also yesterday. And scrolling down, on Saturday, the region's top supplier, Emirates Global Aluminium, said it sustained, quote, "significant damage at its site in Abu Dhabi, while Aluminium Bahrain said it was assessing the extent of the damage to its facilities. So it doesn't sound like we really know the extent of the damage. And perhaps that is one of the reasons why the price hasn't really gone too crazy. We just don't know. Quote, traders need to face the reality of significant cuts to Middle East supplies, said Li Zhueji, head of research at Chaos Ternary Futures. Shutting down and restarting an aluminum smelter is a lengthy and costly task, and the strikes on two of the world's biggest facilities raise the risk that the effect on global production may persist long after the strait is reopened. And get this, aluminum is the most widely used metal after steel, and a sustained price spike would heap further pressure on manufacturers already reeling from the surge in energy costs. And don't forget, as we'd mentioned several times in the past, traders often refer to aluminum as congealed electricity. It takes an enormous amount of power to create aluminum, which is why we continue to see smelters, threaten to shut down, especially as energy costs are rising. So it's facing challenges on several levels here. And if you didn't hear my interview with Andy Holm last week, you may want to listen to that because it really illustrates this in detail. It continues, potentially more worrying for the global economy. The disruption to supplies could be so acute that some industrial consumers would run out of certain specialized products, forcing factories into temporary shutdowns. So this is the deeper concern here. If money solves this problem, one might say, okay, so we have to pay more. But it's a whole different issue, though, if you can't get aluminum. This is something I've actually been discussing here and there for years on this show, which is what happens when the market fails. Our world runs on this notion, say the commodities markets, the metals markets, that the cure for higher prices is higher prices, and that the cure for lower prices is lower prices. In other words, when higher prices happen, more production comes online, and that lowers prices. And if there is too much production, prices go down, and then production curtails. So that all being said, what does it mean if you simply don't have enough? As this article is pointing out, what happens if you run out? Because again, it's like the whole system is predicated on this notion that there is an unlimited amount of these raw materials and that the market will always solve for it. So that is one issue. Another very interesting perspective on this, which was also brought up last week, is this notion that we have a bifurcating market. You look at tungsten. Tungsten continues to rise. What happens when these metals simply run out if the military needs their tungsten? You can assume with a $1.5 trillion budget, they're going to pay whatever it takes to build their missiles. So there's a tension here, is what I'm getting at, between this global price and bifurcated markets. If we don't have a global market, it seems to me that we need more than one price. And to a certain degree, we see that in the oil market with WTI, West Texas Intermediate being an American barrel of oil and Brent crude being a more international priced barrel of oil. So in a sense, we have a precedent, we might say, in the oil markets. The question I ask myself is, are we going to start to see the same thing in metals? And, then you add on the green metals on top of it. So all to say, let's continue here. We have another quote. This is from AZ Global Consulting, who said in a note after the attacks, quote, "The aluminum supply chain has entered a new phase of disruption. We will wait to hear from both companies, but it is clear the system is now exposed to sudden production loss, not just gradual constraint." And we also have a quote from Van Gill's chief executive officer of Hammer Aluminium Industries, which manufactures aluminum products. And they buy commodity-grade aluminum from smelters in Iceland and Norway and sells value-added products. And the company is saying it has become much more cautious about quoting premiums for third-quarter sales given the uncertainty facing the market. For the industry in Europe, the prospect of a series of Middle Eastern smelter closures represents, quote, "an unbelievable threat," he said, and that was before the strikes over the weekend. So before this all happened, we had a story from Reuters on March 26. Guinea and Emirates Global Aluminium near deal to resolve asset dispute. As it says, Guinea has reached an agreement with Emirates Global Aluminium that will avert a looming arbitration over last year's seizure of the miner's local unit, 3 people with knowledge of the matter have told Reuters. As part of the broader resolution, traders and alternative off-takers have been exploring bauxite offtake deals linked to the seized assets, including structures that would use upfront prepayments on future shipments to help settle EGA's claims, according to traders and government officials. So it's interesting timing, isn't it? Let's continue. Another headline, this is Bloomberg News via mining.com. Copper price falls, aluminum price climbs as war keeps traders on edge. So this is interesting as well. I mean, they are both industrial metals, but copper is not falling into the same kinds of deficits as a result of this war, at least not yet, which is likely the reason you're seeing aluminum go up and copper go down. Simple supply and demand fundamentals. Another story, this is CNBC. 3 niche commodity prices are surging. What they show about China's grip on supply chains. And this is from today, March 31st. As it says here, prices of 3 niche elements, tungsten, sulfur, and helium, have climbed sharply in recent weeks. So we're going to go pretty in-depth with Grant Sporre from Bloomberg Intelligence on sulfur today, as well as the copper market and how he is reading it, the concerns around it, his assessment of where we are with copper supply and really the main tension seeming to be sulfur and the Strait of Hormuz right now as the world watches on. Meanwhile, tungsten continues to be in very short supply. As it says here, scrolling down, tungsten hit a record high of over $3,000 last week, making a surge of well over 50% for the month, and more than tripling in price since late December. That's been on the industry benchmark called ammonium paratungstate, APT, in metric ton units, or MTU, from Fast Market, as quoted by tungsten miner Almonte. Scrolling down, the company's CEO, Louis Black, told CNBC, he's actually been on this program, that defense sector demand for tungsten has been, quote, extremely strong since the beginning of last year, but there's been no notable change despite the Iran war. Quote, there's no material to stockpile. That's probably the biggest change, he said. The price of sulfuric acid in Africa is now at least 30% higher than it was prior to the war, and is still rising, citing a local Chinese miner in Africa. Chinese sulfur prices, including cost and freight, climbed about 13% from early March to $621 per ton as of March 26th, according to S&P Global Platts. And we have also a comment from HSBC analysts from a March 16th report, quote, even prior to the Middle East conflict, sulfur prices were rising sharply as the market tightened. With sulfur prices now at fresh record highs, the super squeeze in this rather obscure commodity in supply warrants further examination. And they go on to discuss helium. So major red flags being waved to us via our computer screens here. Again, there does seem to be a bit of a, I guess we call it an arbitration in time here between the words in the stories and our everyday reality. As we continue on, a story out of Australia where you're hearing about fuel shortages. Here it is. This is ABC News, or abc.net.au. Fuel crisis forces WA resources company Blue Cap Mining to send workers home. And that is on March 17th. So that is already almost 2 weeks ago. As it says, fuel shortages linked to the Middle East war have forced a WA gold miner to stand down workers, exposing how smaller miners are being squeezed. Blue Cap Mining says it will stand down 2/3 of its 180-strong fly-in, fly-out workforce in Western Australia. So this is super interesting. I mean, we're still at $4,500 gold here. And a gold company is saying flying in all these people in and out is getting a little too expensive. So interesting story there. And finally, just on the gold front, we have a few interesting headlines. This is from Bloomberg. Iran war threatens to reverse central banks' role as major gold buyers. And this is by Jack Ryan on March 27th. As it says here, Turkey has offloaded $8 billion of gold reserves this month in a bid to protect its currency from soaring energy costs and higher demand for dollars. You know, I was thinking to myself, and I haven't heard this anywhere, but if anything is going to cause a hyperinflation, it seems to me an energy crisis would be near the top of your causes. And so when you look at this story here, this seems to add to my far-out notion here. The country's central bank sold and swapped about 60 tons of bullion over 2 weeks in March. 60 tons. That's bigger than the outflow triggered by investors' flight from gold-backed exchange-traded funds over the same period, which was fueled by a dash for cash amid a broader meltdown in financial markets, rising bond yields, and a resurgent dollar. And we have a quote from Nikki Shields, head of metals strategy at MKS PAMP SA, a trader and refiner. Quote, "The narrative of central banks as perpetual one-directional buyers is being challenged." So perhaps central banks looking to shore up the currency by selling gold. Quite interesting. And finally, a press release from Energy Fuels, courtesy of CEO.ca, which is owned by Earth Labs, which also owns the Northern Miner. And this is courtesy of Newswire, a press release service. Energy Fuels announces first U.S. primary production of critical heavy rare earth material in decades. And this is on the 25th of March, so just last week. Energy Fuels, a leading U.S. producer of uranium, rare earths, and critical materials, today announced it has successfully produced its first kilogram of terbium oxide at its White Mesa mill in Utah. Using monazite ore sourced from the United States, the team achieved a purity of 99.9% terbium at pilot scale, which meets the specifications of global manufacturers of rare earth permanent magnets. This achievement follows the company's recent announcement that it has produced nearly 30% of 99.9% pure dysprosium oxide production, another critical heavy rare earth oxide used in permanent magnets. Of course, the heavy rare earths are where the real bottleneck is in the rare earth discussion. So Energy Fuels, leading the way in North America, fascinating. They continue to make progress over at the White Mesa Mill in Utah. So lots going on here. Again, I'm happy to welcome Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence, to the show for the first time to discuss the copper market and sulfur and the Strait of Hormuz and everything that Grant is considering as he assesses what is happening in the global copper markets, as well as his view on copper companies and what to look for in terms of valuing them. A very interesting discussion with Grant Sporre coming right up. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcast. And with that, let's turn to the news. Turning to the website, BHP sees potash heading toward deficit as demand outpaces supply. This is Bloomberg News on March 24th via mining.com. BHP Group, the world's largest mining company, expects the global potash market to tighten over the next decade as demand grows and geopolitical risks strain fertilizer supply chains. With demand for the crop nutrient rising 2 to 3% annually, there is limited additional supplies beyond BHP's Jansen Potash project. That adds to a fertilizer supply shock triggered by the war in the Middle East as farmers worldwide rush to secure critical nutrients. A market deficit is expected by 2035, according to Karina Gistelink, the group's head of potash. Quote, "We expect a tight market with significant pressure on the supply side," she said in an interview Tuesday. So BHP says the potash market heading for a deficit. Another headline out of Canada, Glencore close in on Quebec copper smelter rescue. So again, just a huge theme here as the West attempts to bolster its supply chains and its metals and processing facilities. Here, another smelter threatening to close, in Canada needing to come in for a rescue. This is by Cecilia Jamasmi at mining.com. Canada and the province of Quebec are moving to keep the country's only and largest copper smelter after Glencore warned it could shut down the facility over stricter pollution rules. The Horn Smelter in Rouyn-Noranda, Quebec, is one of the few plants in North America capable of processing copper concentrate and recycled materials such as electronic waste, making it a critical piece of the continent's supply chain for copper. The Swiss miner and commodities trader paused plans to invest nearly $1 billion Canadian, $718 million US, in its Quebec copper operations last month after talks with the province over arsenic emission limits stalled. Quote, "While awaiting regulatory certainty, we are open to evaluating other mechanisms, particularly financial ones, for sharing risks," Glencore said in a statement to Bloomberg, signaling willingness to continue discussions. Quebec has proposed legislative changes that would give the company more time to meet stricter emissions targets. Scrolling down, the outcome carries broader implications for North America's copper market, where smelting capacity already lags demand, particularly in the United States, and where a shutdown would tighten supply further amid global disruptions. Canada supplies about 17% of U.S. copper imports, ranking second behind Chile, the world's largest producer of the metal, underscoring the strategic importance of the Horn facility. So, government taking action and being quite responsive in ways that we simply never saw, 10 years ago. Continuing on, judge upholds U.S. government approval of Ioneer's Nevada lithium mine. This is Reuters on March 30th. A federal judge rejected claims by environmentalists that the U.S. government in 2024 improperly approved Ioneer's Rhyolite Ridge lithium and boron mine in Nevada in a ruling on Monday that boosts efforts to increase U.S. critical minerals production. U.S. District Judge Christina Silva ruled in Las Vegas that U.S. Interior Department regulators during Democratic former President Joe Biden's administration sufficiently analyzed how the planned Rhyolite Ridge mine could affect Team's buckwheat, a rare wildflower that Ioneer has vowed to protect. So a rare wildflower holding up a major lithium development. Interestingly, shares of Ioneer gained about 24% in afternoon trading on the New York Stock Exchange. And of course, lithium is having a bit of a run. Last I checked, it was at $23 a kilogram, so it is starting to perk back up into the headlines here. Continuing on, also another lithium headline in the United States. GM-backed Energy X to launch Texas lithium facility, and this is Reuters via mining.com on March 26. Energy X, a startup backed by General Motors, said on Thursday it has commissioned a lithium production facility at its project Lone Star, located in the Smackover Formation in Texas. Lithium demand has been surging globally, driven by the role of lithium-ion batteries in electric vehicles, portable electronics, and increased adoption of renewable energy storage solutions. The Lone Star demonstration plant is operational and will produce roughly 250 metric tons per year of battery-grade lithium carbonate equivalent, the company said. Lithium refining remains a bottleneck in the U.S., with China controlling about 70 to 75% of global lithium chemical conversion capacity. Continuing on the lithium front, we have an update from the Congo. Zijin's Congo lithium mine set to be among the world's biggest. It's Bloomberg News via mining.com, so we were hearing about Zijin Mining last week and how they want to expand beyond gold and copper. The lithium mine Zijin Mining Group plans to open this year in the Democratic Republic of Congo is set to be one of the world's biggest suppliers of the battery metal. The Chinese company, which has grown at breakneck speed to become a top producer of copper and gold, has been developing the Monono Lithium project in southeastern Congo since it secured the prize deposit in 2023. I mean, they're already opening it. It's pretty impressive. The mine, which Zijin aims to commission this June, will be able to supply 130 tons of lithium carbonate equivalent a year once it reaches full capacity, according to a report the company released on March 20th. That would, quote, put Monono in the highest echelons, end quote, of hard rock lithium assets, with only a couple of giant mines in Australia having the capacity to produce more, said Martin Jackson, head of battery material markets at consultancy CRU Group. And another related headline, Congo, China deepen mining ties as U.S. pushes rival minerals pact. And this is Reuters on March 27th via mining.com. So Congo continues to be central. And here is what it says. The Democratic Republic of Congo and China have signed a deal to deepen cooperation in the African nation's mining sector, Congo's government said, as global powers jockey for influence in the strategically important minerals powerhouse. Congo is the world's leading producer of cobalt and holds vast reserves of copper, lithium, coltan, and other battery metals. Chinese companies led by top cobalt miner CMOC, Zijin, and YU already dominate its mining sector, and Beijing is also Congo's biggest bilateral creditor. However, the United States and other countries seeking supplies of the minerals needed for electric vehicle manufacturing and the energy transition are also courting Kinshasa. Joshua Walker of NYU's Congo Research Group said about the new agreement, quote, "The U.S. will certainly take notice. It is clearly a riposte to Washington." I looked up riposte, not a commonly used word, basically an offensive action. It is clearly a riposte to Washington. Scrolling down, but as Beijing and Washington compete globally for resources, the Congolese government, which is seeking to capitalize on the country's vast reserves of critical minerals, is not picking sides. Quote, "The DRC is clearly attempting to hedge its bets," Walker said. Probably a smart move. Continuing on, Ethiopia signs $13.1 billion of energy and mining investment deals. This is Bloomberg News via mining.com on March 27th. Ethiopia has signed $13.1 billion of investment deals spanning renewable energy, manufacturing, real estate, mining, and green ammonia, according to the government. Representatives of the investing companies from China, Poland, India, Singapore, and Kenya converged on the capital, Addis Ababa, to ink accords at the Investment in Ethiopia conference. Quote, "These are a great success, but they are only a starting point," said Zaleki Temesgen, head of the Ethiopian Investment Commission. Quote, "The real success will be how quickly these investment commitments translate into operational promise on the ground." So Ethiopia is signing some pretty big deals there. Another headline, Australia's Metallium signs 10-year U.S. critical minerals offtake deal. This is Reuters via mining.com. Australia's Metallium said on Tuesday its U.S. unit, Flash Metals USA, had signed a 10-year offtake agreement with Indium Corporation to supply recovered critical metals from its U.S. recycling operations. Under the deal, Flash Metals USA will supply gallium, germanium, copper, tin, gold, and indium to the U.S.-based specialty materials refiner, with pricing set under a formula-based schedule, Metallium said. More deals being done. And another interesting headline, U.S. deep-sea mineral processing plant planned by Glomar and Cobalt Blue. This is Reuters via mining.com on March 29th. Deep-sea mining firm Glomar Minerals and Australia's Cobalt Blue Holdings said on Monday they plan to build a U.S. refinery to process critical minerals extracted from the bottom of the Pacific Ocean within 3 years. That is the first deep-sea mineral processing plant facility that I have read about here, interestingly. And finally, a headline from Bloomberg News via mining.com, energy shocks will slow climate action, BHP executive says. And here we hear from Geraldine Slattery, president of BHP's Australian operations. Quote, "Geopolitical fragmentation has repositioned resources and energy from traded commodities into instruments of national power. Resource and energy security and affordability have overtaken supply chain decarbonization as the dominant policy priority in many major economies." So this is the second story, the first being Glencore and the smelter in Quebec, where we've seen a pushback on the environment in a very public way, which would have been unthinkable, I would argue, 4 years ago. So a shift in sentiment towards ESG, or environmental, social, and governance policy. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.32%. That is 0.04% lower than last week. The UK 10-year gilt edges slightly lower, yielding 4.92%. That is down 0.01% on the week. Italy's 10-year bond is yielding 3.98%. That is 0.06% higher on the week. And that is almost 0.33% higher than 2 weeks ago. So yields in Italy jumping. France's 10-year bond is yielding 3.76%. That is 0.03% higher. Now, it seems to me that some of the bond yields are moving higher based on the reliance on energy. Of course, Italy was one of the countries that was faced with force majeure from LNG supply in the Persian Gulf, where France has a strong nuclear fleet, and so perhaps that is the reason we're seeing Italy bond yields rise quite a bit faster than France's. Germany's 10-year bond is yielding 3.03%. That is 0.02% higher on the week, and again, above 3%. And, of course, Germany destroying. I'll never forget it. It was only a few months ago that you saw some of these nuclear plants be destroyed on X. And continuing on, Japan's 10-year bond is yielding 2.36%. That is 0.1% higher. And so continuing, it's tempted to call it to continue to blow out here, seemingly, or to move dramatically higher after consolidating in the 2 to 2.27% range, breaking out. And finally, China's 10-year bond is yielding 1.81%. That is down 0.02% on the week. And perhaps again, the investment in renewable energy and everything China has done to become resource independent paying off in the interest it pays on its 10-year bond. Very interesting. Turning to precious metals. Gold is trading at $4,571.20 per ounce. That is $162 higher than last week. So gold having a good week. Silver is trading at $73.40 per ounce. That is $4 higher on the week. Platinum is trading at $1,873.80 per ounce. That is $2 higher on the week, so slightly higher. And palladium is trading at $1,421.50 per ounce. That is $18 lower on the week. So a mixed bag in the precious metals. Turning to industrial metals, copper is slightly higher at $5.48 per pound. That is 2 cents higher on the week. Iron ore is at $106.22 per metric ton. That is 33 cents higher on the week. But above $106, which is not super common, we saw it about 3 months ago when it hit $108. Now at $106 on the rise. Aluminum is trading at $1.56 per pound. That is 10 cents higher on the week. With everything being said, I'd say not bad at all. Lead is at 87 cents per pound. That is a penny higher on the week. Nickel is trading at $7.83 per pound. That is 7 cents higher on the week. Tin is trading at $20.77 per pound. That is $1 higher on the week and back above $20. Cobalt is unchanged at $25.53 per pound. Lithium continues to climb at $23.80 per kilogram. That is $2.52 higher than last week. Uranium is slightly lower at $84.05 per pound. That is 35 cents lower on the week. And zinc jumps to $1.45 per pound. That is 5 cents higher on the week. Zooming out, a bit of a mixed bag where it seems that traders are unsure on whether to invest in the supply constraint story or a faltering global economy story and high energy prices. The real standout here is lithium climbing about 10% on the week, and perhaps with all of the trouble with the energy sector and oil and LNG, lithium may be catching a bid based on that. And those are your metal prices. Coming up, I'm very pleased to welcome for the first time to the Northern Miner podcast, Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence. We discuss the copper market and the increasingly important sulfur market. A significant portion of supply comes out of the Persian Gulf and through the Strait of Hormuz. And as Grant explains, this helps process the copper in the Copperbelt in the Democratic Republic of Congo and Zambia. So supply chains continue to be out of whack. Grant helps fill us in on what is going on with copper, sulfur, and the copper miners. I hope you enjoy the conversation, and I will see you on the other side. Joining us today, I'm very pleased to welcome to the Northern Miner podcast for the very first time, Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence. Grant, welcome to the show.
Adrian, thank you very much for having me. I look forward to a great discussion.
As do I. It's a delight and a pleasure to have you. And you've been writing on copper recently. And of course, aluminum has gotten, as far as metals and the Strait of Hormuz in terms of the headlines, aluminum has kind of been perhaps the most pressing of the concerns around the metals. But I mean, how is copper being impacted by the Strait of Hormuz? I assume it is on some level.
I would say the impact directly on the market on copper is a lot less than it is for aluminium. So, I mean, the Middle East, and, if we include Iran in that, accounts for around about 2% of supply and 3% of demand versus 9% of supply when it comes to aluminium. So the actual direct impact from, let's say, any disruptions from shipping in and out of the Strait of Hormuz is pretty limited. And a lot of Iranian copper production is well away from the heavy bombed areas, and it typically makes its way, a lot of it, into China as well. So the impact is very light directly. And I think it's the secondary or the second derivative impact that's starting to filter through to the market. And that is, oil prices, wherever they may land, let's call it, above 120, maybe even higher, well, certainly higher, depending on how long this conflict lasts for. That's going to have a real impact on global growth. And as a sort of a barometer of that, copper is going to suffer. So, aluminium benefits from supply disruptions, copper doesn't, and is probably going to take a hit from demand.
Interesting. So unlike aluminum, copper, the supply will not be affected quite as dramatically. It will be somewhat, as you put it. However, it's more indirect, the actual impact in terms of the copper market, in terms of, okay, if there's a global recession, that's not good for copper. Is that a fair characterization?
Yeah, that's it perfectly. Now, I must say, there is another secondary impact, and I may as well mention it now, is in terms of, again, over a protracted period of time, we get a lot of sulfur as a byproduct of oil refining in the Middle East being exported to the rest of the world. And, the area that's particularly vulnerable to disruptions to that sulfur supply is the DRC, Democratic Republic of Congo, and to a lesser extent, Zambia. That region accounts for about 15 to 18% of global copper output. And in the DRC particularly, a good 60% of that output is solvent extraction electrowinning, which relies on sulfuric acid. The region is short sulfuric acid, so they need to import sulfur from which they make sulfuric acid. And over time, that could actually impact the output there. So I suppose that's, now we have to make a judgment. Is the demand impact going to be, more or higher than perhaps the supply impact from that particular region? Now, my overall assessment is yes, it probably will be, because these are heap leach operations effectively, and you keep recycling sulfuric acid, and it's sort of a gradual grind down if you don't keep replenishing that sulfuric acid. So there is a bit of a supply offset in copper. We're probably not seeing it now, other than in the price. That's obviously got another impact there. But I think over time, net, the demand impact is certainly going to outweigh that supply impact.
It is interesting, isn't it? Because, the sulfur issue, it's, people talk about the Strait of Hormuz and, all of these kind of unknown things that go through the strait that people weren't aware of. Sulfur, I'd say, was definitely, at least for many people, one of those issues. So all to say, speaking somewhat hypothetically here, so if the sulfur supply was to stop out of the Persian Gulf, how big of an issue is that? Like, do you know how much sulfur comes out of there that is required, or do you have an idea of how much people have on stock, or is that an unknown at this point?
We've had some anecdotal news coming out and some sort of supply chain checks, but they're not definitive. We've heard sort of that there were about 3 to 4 weeks worth of sulfur stockpiles in the DRC. Now, obviously, the war's pretty much down 4 weeks. I'm not sure if we've depleted those, but I would imagine that stockpiles are being driven down. And then again, I've heard varying estimates, but apparently around about, again, so the number's about 50 to 60% of sulfur comes from the Gulf directly to Central Africa via Tanzania and that route. That seems to be the best route. Now, I will say, look, over time, and we saw this coming out of the Russian invasion of Ukraine, how trade routes rewire themselves quite quickly and how the market adapts. So I would expect some adaptation, but there will be certainly an impact. Probably, I would say, probably towards the second half of the year, we'll start to see, production starting to maybe not grind down, but the DRC is meant to actually, deliver an uptick in production, and we may not get that uptick in output.
In a sense, it's another risk factor, just another kind of unknown variable that could impact supply. Another issue is, say, the companies themselves and energy costs, right? I mean, if all of a sudden your energy costs double, let's say, does that impact your production? And if the price is lower, I assume that would not generate as much copper if, say, we had high energy prices and low copper prices. What is your assessment, say, of miners and energy costs?
The initial direct impact is probably not as big as you would think. So, well, let's take the sort of average Chilean miner, with the region Peru and Chile account for, again, slightly more than a third of global copper. a lot of their energy actually comes from renewable. So, the energy to drive the mills and all the processing, which is quite power intensive, tends not to rely directly on oil. And the linkage between oil and power, particularly in Chile, is probably broken a little bit. So it's hydro and renewables to a large degree. So you need diesel basically to run your trucks and to, dig the ore out of the ground. And that accounts for, sort of 5 to 8% of your cost base. So sure, a doubling of oil prices is certainly going to have an impact on that little slice of the cost pie. But again, it's not going to be too unmanageable, if you like. Again, the sulfuric acid, even in Chile, although they're not reliant on sulfur, any spare sulfuric acid that is out there is going to be, you're going to get competition. It's a bit the same as in the LNG market now, where Europe doesn't really get LNG cargoes directly from the Middle East, but anything spare is being competed for, particularly out of Asia. So prices are going to go up. So again, that component of let's say your reagents is going to be impacted as well. And again, over time, you're going to have that whole energy impact from oil is going to create this inflationary environment. And that is slowly going to pervade all other sort of aspects of your cost base, be it your reagents, which some of them do have an oil base. And obviously then labor, transport particularly, will be impacted as well. So, we've done some analysis. Codelco came out today and actually said, look, they think the impact is going to be a 5% increase to their costs. That's not too onerous, I would have thought. I would say that's, looking at it on a very short-term basis. Again, the longer this drags on, if it becomes, multi-month heading on a year, I'd say that cost impact will be higher as that inflationary wave starts to build. And it could be as high as 15%, if we get to sort of the middle of next year. If you look at the various components of it, acid, direct energy, and then all your reagents, and even starting to creep into labor and services.
That is the thing with energy, isn't it? It affects like all levels of the supply chain. This isn't kind of a one variable issue. It's the variable that impacts all other variables to a certain degree.
Totally. And by the way, higher energy prices are also going to impact demand. I do think that a lot of the producers are going to get squeezed both on the revenue line and the cost line. So margins, the longer this drags on, I think the more margins get squeezed for a lot of the producers. And obviously, I think it impacts those high cost producers more because, the high cost producers on the cost curve tend to be the oxide, solvent extraction electrowinning producers, which need the acid. They also don't have gold or byproduct credits. The mines tend not to be polymetallic. So I think you'll get a lifting of the cost curve, but it'll also skew as well. It'll also tilt in favor of the lower cost producers.
Right. So we have higher copper prices right now. So in a sense, all things considered, 5 to 15%, not terrible, we could say at this point. Now, you mentioned Southern Copper, Antofagasta, and First Quantum in your note. How are these companies exposed, in a sense, to everything that's happening in the Persian Gulf?
I could have chucked in Freeport as well, as the biggest sort of pure play copper producer. The reality is that, Southern Copper is your most, let's say, is your lowest cost producer. So they've got a lot of margin to play for. So arguably their costs they're going to be the most defensive just because they've got the best margins. So it's the low cost producers, again, they've got a lot of byproducts, probably going to be best off. Somebody like, at the moment, particularly First Quantum, where their Panama mine hasn't restarted and there's uncertainty as to when it will restart. So all of their operations are in Zambia, and that is a slightly higher cost region, and it is more susceptible to inflation. And again, they will be closer to the epicenter where the acid or sulfur shortage will hit. And I think they'll feel the pressure the most. And again, their margins are probably lower than, let's say, a Southern Copper or indeed an Antofagasta for that matter. So I think that's the kind of way that we look at it. I focus purely on the pure plays. Obviously, all the diversified miners, the Glencores, the Anglos, the BHPs, all have large copper operations as well. But they tend to be slightly higher margin, and they've got, other commodities which will probably buffer the margins that they get in copper.
Okay, very interesting. And what about Freeport? I guess they'd be like a copper gold. They have that giant mine. What is it, the Grasberg mine? Do you have any thoughts on Freeport?
Yeah, look, they're in recovery mode in Indonesia. So in Grasberg, they also had the mudslide. It's going to be a slow recovery through this year, and they probably hit their straps as we head into 2027. Certainly, if you base that on management guidance. The good thing is they have a copper smelting portfolio as well, so they produce a bit of acid, so they're not totally exposed or totally short acid. So they've got a little bit of a buffer there, but they have got, a lot of their North American operations or the US operations are reliant on acid. As a region, the US is probably, I wouldn't say it's not totally insulated, but it probably has a little bit more of a buffer. So net, they probably are a little bit, they have a slight shelter compared to some of the other, such as First Quantum, which is, totally African at the moment.
Okay, excellent. And so as you're looking out, Grant, what are you looking at in terms of, for example, like have you gamed this out somewhat? Let's say conditions persist as they have for the last month and continue for a few more months, maybe $150 oil. What are you paying attention to? What kind of concerns or risks are out there in terms of the copper market?
I want to take a step back here because I suppose we started off the year on a slightly weak footing when it came to the copper market. And the reason I say that is, particularly in China, we looked at all the sort of end demand indicators and they really slowed down towards the end of last year. And I'm talking, consumer durable sales, auto sales, grid investment, property starts, all of those sort of pointed to a demand contraction in the fourth quarter. And to a certain extent, I think because of the high price environment, there was almost a buyer's strike. People were putting off purchases, the downstream processes, their utilization rates contracted. So the immediate demand situation in China looked pretty weak as we came into the first quarter of the year. So essentially, China was almost in destocking mode towards the end of last year. And we didn't really see that much of a pickup in the first quarter. The first quarter is always a little bit tricky because you have Lunar New Year and, the buying behavior, and that gets a little bit disrupted by that. But as we've come out of it, it doesn't look like there's a whole heap of optimism and the demand outlook doesn't look that strong. So we're already on a slightly cautious note when it comes to demand. And then what we've also saw is we saw visible inventories really shoot up globally. And and that's the sum of inventories on the COMEX, the LME, and the Shanghai Futures Exchange. Now, a lot of that, I think, is all those stocks that were being held off exchange made their way onto exchange. So I don't think it's all of a sudden, all of that is due to the fact that there's been a bit of a weakness in the market. It's not pure surplus. It's copper that was always there that's just suddenly we're aware of it or it's become visible. But nevertheless, both of those signals, the demand signals in China and the inventory signals were, I think, pretty negative to start off with. And yet the price had looked through that. So I think we started off quite on a weak footing. So initially when I look at pure supply demand, if I look at it from a bottom-up fundamental perspective, we started off this year with a small deficit, and that's already expecting demand growth to slow, mine supply to struggle a little bit. I think if the war carries on for another, let's say, couple of months, the market probably moves to more of a balanced outlook. Does that justify $12,000 a ton? I don't think so. I think it justifies a lower price than that. If it extends even further and that real inflationary growth shock comes through, then we're into a surplus market. I think we'll test $10,000 a ton again. So those are sort of the two main scenarios that I've looked at. And even in my protected scenario, I do offset some of that with less supply coming out of Central Africa. But net, I still get us into a surplus market. So, that's kind of the way that I've got some scenarios and the way that I've analyzed it.
Very interesting. And so I think people would be surprised, in a sense, to hear that the outlook for copper, say at the start of the year, was kind of not that great in a sense, because all you heard on X or on YouTube was how we're having a shortage of copper. Now, in terms of timelines, then, I guess that is a factor too, in terms of the context here. I mean, big picture, what we were hearing at least is, at least say Robert Friedland, no small personality in the mining sphere, was basically saying, we have a major issue with copper supply. Big picture, over the longer term, do you agree with that more or less? Or what is your sense of that?
So the way that I look at it, and I do agree, the copper market, depending on how the Iran war plays out, does look tight. So structurally, yes, it is tight. And the reason I would say that is if you take demand growth since the end of the Second World War, when we had the reconstruction of Europe and Japan, and we've been through various sort of industrialization, services led back to industrialization, the average demand growth is around 2.5%. So let's call that trend. And I suppose if we take it back to sort of 2017, 2018, somewhere around there, the narrative in the copper market was, okay, China's slowing down, copper demand is going to be below trend. And then we got to, the end of 2018, 2019, even into 2020, and suddenly, decarbonization, electrification, that narrative started to really come into the copper market. And the sort of overwhelming thought was, okay, we're going to be above trend demand. These drivers are really going to push demand. Now, I think it's somewhere in between. And I honestly think, we might be slightly above, but we're not going to be 4.5%. It might be 2.8, possibly 3%. And in fairness, refined demand has grown close to 3.5%, 4% over the past 2 years. But that's why I'm saying the signs, that sort of narrative was still pervasive in the copper market. That's why I'm saying I think the signs that we saw towards the end of last year was kind of, okay, well, it's a short-term glitch, and the demand drivers will look through that. And then on the supply side, we've had multiple mine disruptions, the lack of investment, or sometimes the ability not to be able to develop mine plans and that because of COVID. And we're still suffering a little bit from the hangover of COVID, where, a lot of work wasn't done, is still hanging on the copper market. So, if you just looked at that picture and you projected just that going forward, then we did look like we had deficits as far as the eye could see. Now, given my experience, I think something always gives, and we are starting to see the miners actually come to the party in terms of bringing forward projects, starting to invest some capital in them. So I think the mining industry has woken up. Now, there's a time lag to that. So I think, there's a good couple of years when that's not going to be hitting the market. And, I suppose the key thing is if demand keeps going at 2.5% to 3%, then yes, the market stays very, very tight. But I think, if you look over history, there's always there's always a bit of a disruption, which just gives you that sort of break, that fire break in demand. And, you'll get a year where it's, below 1%. And then it sort of resets things. And then the market going forward doesn't look quite as tight as it had. And I think that the Iran war may just be that sort of little fire break that we need from a copper demand to sort of balance things out a little bit.
Okay, excellent. Yeah, and it is worth keeping in mind that Robert Friedland is in the business of selling copper. So, so what should investors then, as they, look at copper companies, what should they be looking for, in your view, in order to, value them accurately? Do you have any thoughts on the kinds of things that they should be looking for?
So, I mean, the key thing from looking at it through the lens of a copper miner at the moment is they do need to invest and they do need to bring on new copper units. So there's no doubt about that. So the key thing going forward is capital intensity. How much do you have to spend to bring on new production? And that determines what returns you're going to generate from the project and what your sort of minimum copper price should be. The team has done a lot of work in terms of modeling lots of different projects, and the sort of copper price we get to is around $10,000 a ton. That's kind of a decent price for a lot of good quality projects, not the sort of more expensive projects, to give you your sort of 13 to 15% IRR on a project. But it all comes at a decent capital intensity, and we've got to strive for below $30,000 a ton of capital being invested. So I think, investors should really look at the quality of the projects a particular mining company is bringing to the table, and particularly focus on the capital intensity. That's going to be a key feature. And then, in the shorter term, in terms of where we are in the cycle and are we going through a bit of a bump, the demand indicators in China, I think, are very important to keep an eye on. And over the past 6 months, I think the market has sort of drifted away and saying, look, China's not that important anymore. It's more about the broader electrification and all the rest of it. And I agree, we don't have to be quite as China-centric, but we shouldn't ignore what's going on there, given that they, demand more than half the world's copper.
Okay, excellent. So finally, then, as we zoom out here, Grant, what is top of mind for you? I mean, I suppose it's what's happening in Iran. But what are you thinking about? Do you have any final thoughts for us as we wrap up here?
So before the Iran war, the key sort of question or the key thing that was top of mind was where are we going to see the demand destruction? Because prices had rallied to, above $13,000 a ton. We'd seen buyers sort of step away from the market. I was actively looking at, okay, where can we substitute? Battery vehicles, and particularly there's a lot of work going on to minimize your materials usage in batteries, switching to aluminium. Now, because we've got an aluminium problem, maybe that doesn't happen as quickly. That was front of mind heading into the Iran war. And I still think it's going to be something to watch for. So anything like where a supplier says, okay, we're replacing all of these medium voltage copper cables with an aluminium alloy is something that I keep my eye out for. But of course, world events have upstaged that. So it's a duration thing, I think, for the Iran war is, okay, how long is this going to drag on? Because that's going to have more of a demand impact. And obviously, then we have to assess whether even if there's some sort of resolution, is it a real resolution, or do things just keep dragging on and still impact global growth? So I suppose those are the sort of, let's say, three things that are top of mind at the moment.
Okay, excellent. And just finally, so if it doesn't reopen, then the Strait of Hormuz, what does that mean? I mean, ultimately, as far as the copper market is concerned, is the sulfur really the biggest issue? Should it not reopen?
Yeah, if it drags on, I don't think it's going to be absolutely no ships go through. There's going to be selective cargoes that go through. So it's not going to be a total, no sulfur is going to get to Central Africa. There will be some, but it won't be, it won't be at 100% or 100% of what they need. That's going to be the main direct impact. But at $200 a barrel oil, that is going to have some impact on global growth. And I think that's going to be the number that we're going to be looking for is just simply for the demand impact, it will be the oil price.
Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence. Thank you for joining us and sharing all of your views on the copper market.
Adrian, thank you very much for having me.
Thank you once again to Grant Sporre of Bloomberg Intelligence for appearing on this week's show. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.